Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next 25 minutes here on Options Guide TV. We're at the very tail end of earnings season. We do have some economic data as we do week in and week out. We have the Fed is probably the highlight of the economic data. That's anticipated that they will do a rate cut, but a lot of things are changing in that space, and the probability of continued rate cuts has been decreased quite a bit. And the VIX is actually showing this data just in general. The VIX has came up to about the 15 level from down around the 13 level. Thought the 13 level was a little bit too low. Didn't have that opportunity to actually go out and buy and get long the VIX, but I do want to get long the VIX going into the inauguration, into the new year. I'm a little bit feel like there's going to be a buy the rumor, sell the news. Everything is euphoric at this point in time, but there hasn't been any policies that have obviously changed because we are waiting for a change of the guard as far as the White House is concerned. So there's a lot of euphoria around what may happen. But obviously, there's going to be more problems trying to make whatever that euphoric data is actually happen. So, because of that, I want to get short the market a little bit by getting long the VIX. So that's going to be my outlook going into the new year. We're running into the Christmas holiday. And they always have the Santa. A lot of people like to talk about the Santa Claus rally between Christmas and New Year's, and it's usually done because of the managing of portfolio by portfolio managers going into the end of the year, taking profits, getting ready for year end. That's what a lot of people will say. Not to mention the fact that you have the holiday this season, and a lot of those numbers are coming in from all the consumer spending that happens over the holiday. So with that said, I am going to take advantage of the fact that FedEx is going to announce earnings, and FedEx has struggled. Basically they had such a bump up because of COVID. Now they have had increased employee costs, increased just costs all the way across the board. Economies abroad, it's a very obviously FedEx is all around the globe, and the economies abroad have kind of waned a little bit as far as growth is concerned. The only real strong economy right now is the U.S. at this point in time. Kind of in general, that's true. And that is actually kind of hurting FedEx. So I want to get bearish on FedEx going into their earnings report. Their earnings report is going to be Thursday after the close. Obviously, today is Wednesday, and I would normally put this trade on Thursday if I'm doing it specifically around earnings. But I'm going to give you the setup. I'm going to do a butterfly around earnings, and I think longer term you could get bearish on FedEx. So FedEx is actually kind of trading a little bit odd because of the forecasts on earnings and the fact that they are looking for slower growth, and that their revenues are anticipated to be waning year over year. So with all that said, I don't mind going out longer in time and actually being a little bit bearish on FedEx. But the fact that they're going to announce on a Thursday, and I've talked about this a lot, and we only have 1 day for the option contracts to live after they announce, and that it's a $279 stock, that it's an expensive stock, allows me to look at butterflies because all that time premium has to come out in 1 day. So I want to manage my risk by looking at the cost, and I'm going to give you a couple of ways to look at FedEx today. And so let's do it. Let's run to the Tradier Pro software. Here's where FedEx is at right now, 279.56. Now, the first trade that I want to look at doing is going to be a modified butterfly to the downside. And then we'll also look at a skip strike butterfly to the upside, which to me, once again, is an alternative to selling a short call spread, is the way that I'm going to approach this trade. So I'm going to give you two different options. I personally will probably do the modified butterfly because I'm a little bit bullish on it or bearish on it, and the fact that that FedEx is kind of bouncing back a little bit today kind of makes me want to get a little bit more bearish. I had a pretty big down day yesterday, so it's really been volatile. The implied volatility is quite high actually at this point in time. If you look at the December 20th expiration, which I'm highlighting here inside the options grid of the Tradier Pro software, we're seeing that the implied vol is right around 170 with the historic vol right around 53. So if we look at the expected move on the 280 strike, where we're buying the at the money call and buying the at the money put, that's the expected move around earnings. At this point in time, it's pretty close to $30. So it makes the math fairly simple. $30 on a $280 stock is, we're talking about a 10% move that the marketplace is expecting going into the earnings report, basically saying by this Friday's close, this is a possible move. I like to always think of it as the over under, if you use that betting terminology, like the line would be on a football game, total points scored. Are they going to score over this number of points, or are they going to score under this number of points? And that's a combination of both teams. In this instance, we're looking at a combination of the call and the put. Do you think that the market can move more than what the long straddle would be, or do you think it would move less than what the long straddle would be? And that's about a 10% move. So I always add that in whenever I'm looking at earnings, especially on a very popular stock like FedEx. Obviously, a lot of volume, a lot of open interest on the option contracts, decent markets. If I'm doing this trade and we see a 30-point move, well, the market's at 280 right now. 30 points would be 250. So I want my butterfly, which you've seen, I already have it set up and I'll show it. I want that to be within the expected move. If I'm going to do this trade and I'm expecting to get a profit, I don't want to go way out in time and make it too cheap. And I want to take what the marketplace gives me, use that information to try to set up my strikes. Now, 30 points isn't a given, right? And direction is definitely not a given. So expected move never has anything to do with direction. But if I'm setting this trade up and I wanted to come out and just buy the 250 strike, right? That's $3.30, $3.50 on the ask. So we'll split the difference. We'll call it 340 right in the middle. And that's what it would cost me to buy the option contract that is at the expected move. Now, I don't want to buy that individually, mainly because the marketplace says that's where it's supposed to go. It's not saying that it's going to blow through that move. If it blow through that, you're looking down to the 242 level. That's where a 1 standard deviation move is. And if we look at that, we have, well, here it's actually a little less than that. It's be right about 245, right in that range, because that's the 13 delta, where you got the 247 is the 15 delta. So we're somewhere right around here on the expected move, right around that 245 level. So that means that you got at least a 14% chance of it going to your 245 strike, right? And then if you're talking about a 2 standard deviation move, now you're talking about blowing all the way through the 235 strike, which we'll be okay on because of the way that we're setting up the trade. But that is a very low probability. About 95% of the time, the market does not make that move. And that's where we're at. And that's how I'm going to set the whole trade up. Take what the market is giving you, use that to select your strikes, and then go ahead and place the trade. That's simple. Never want to buy, but I bring up this 250 strike because that is the expected move. And we're going to pay a lot less than that. Even though this is within our range, we're going to pay quite a bit lower than the 350. How are we going to do that? We're going to set up our butterfly. Okay, so we're on the put side of things on the options grid. This is the call side. Implied volatility is 170. The expected move at 280 is $30 or 10%. Puts it right around the 250 mark. We're going to buy the 260 and we're going to go 15 points down. That gives us 15. That means that the maximum upside of this trade can be 15 points or $1,500, which that only occurs if it stops right at 245, right at expiration. They're announcing on Thursday after the close. I would wait to set up this trade and put it on Thursday, but we're going to do it right now because this is when we tape the show. And based off of all that information, you can grab this information and go tomorrow and look at it, everything basically the same way. But I don't mind putting on this trade right now. It's okay to set it up based off of the current information. I'm all right with it. All right. So the market's already, I guess the market's already going up. Now we're at 250 on the midpoint, and we'll call it 250. Here's our trade. We're going to buy one of the 260 strike puts with the December 20th expiration, 2 days away, 12/20. This is our expiration over here. We're going to buy that 260. We're going to go down 15 points. We're going to buy the 245, or we're going to sell the 245. We're going to sell that twice to be the center strike of our butterfly. And then our short spread, we're going to stop short. We're going to only go 10 points. And we're going to buy the 235. That will increase the cost of our butterfly overall. But like I said, even if we went and just bought the 250 outright, that's $3.50. If we want to buy even something that would be more feasible, like the 160, that's $6. So we're greatly reducing the cost. We're saying that the marketplace more than likely won't make more than 2 standard deviation move. The thing that actually kind of hurts it, well, the thing that hurts us the most is if the market goes up. If they announce earnings and the market doesn't do well and it goes up, that would be an issue on this trade. We would lose this 250. That's simple. That's straightforward. If the market kind of goes down, there's going to be an opportunity to get out if we can kind of get somewhere in this range from 280 to 260. If it goes to 260 all the way down to 235, well, that's a home run. If it continues on down, we still do okay. And I'm going to show you that in the what if calculator. And let me go and do that right now. Send this to the what if. And here's what I'm highlighting here. This is where the current market is at, 279.50. If we do this trade and the market goes down to 260, well, we're okay. From 260, well, basically where our break even is at, this would be 260 minus 250 or 257.50. That would be where our break even is at on expiration. But to start with, this is what our profit and loss graph looks like. As expiration approaches, right in the middle, this would be our maximum upside. And you have to look at the profit and loss over here, which would be the 15 points minus the 250 or whatever we ended up paying for the trade. That would be our maximum upside. And then if it continues on down, since we stopped short, we did a 15-point wide butterfly, and our short spread is only 10 points wide. That means that from this point on down, the butterfly should still be trading for $5. You paid $250 for it. You should be up about $250 on the trade. And that's what this is showing you. So we're bearish. We want the market, if the market goes down and you don't get a huge volatility crush and it just kind of moves half of the expected move, you'd want to get out right away. So if by 10 o'clock it's moved, the market's open at 9:30 Eastern time, it's moved half the way, and it's trading somewhere around $2.50. I think you just want to close it and get out of the trade. If we're pushing the 260, well, then you got a decision. Like, do you want, how far do you want the market to go before the expiration on Friday? And what risks are you willing to take? And if it blows the numbers away and it gaps the expected move open and goes on down, well, just let it ride. No big deal on this trade, and just close it out at the end, and hopefully you're going to make at least 250 on the trade, because this would be trading for $5. Now, if you have any questions on this, please feel free to put them in the chat box. I do see we got one comment. Not much of a comment at all, but we'll leave it there. And so with that said, this would be the official paper trade in FedEx going into their earnings announcement on Thursday after the close. Now, I promised you that I would look at a different trade, a different way to get bearish. So on the opposite side of things, using all that information, I'm going to close this out. We can look at a skip strike butterfly. Now, I like the fact that FedEx is a $280 stock. That kind of makes these trades interesting. the more expensive the trade. So you got an expensive underlying, which adds premium, and then you got a high implied volatility, which adds premium, and it makes these interesting butterflies just even on a one lot to look at these trades. So we have the 280 strike. If we look at the expected move, you're talking about 310. So I'm going to go a little bit more beyond that because we have additional risk if we get a huge gap open and it does do at least a 1 standard deviation move. Then we do have additional risk on this. So I'm going to start my trade at about the 1 standard deviation move, which is around the 315 level. The delta there is 18, and the 317.50 is about 17. Okay, so then this trade, I'm going to buy this option contract. So I want the market to stay, well, ideally if it goes below this, because we're going to do this for a net credit to the account. This is going to have a little bit more additional risk than our modified butterfly that we did with puts. Notice we're on the call side of things over on this area. And then we are going to go up 10 points and 315, 325, and we're going to sell 2 of these. And then we're going to skip a strike. So 315 to 325. This is our sweet spot right in this range. If the market goes to 335, 345, then we're going to buy this one. Wrong scenario. When we're going to buy this one. All right. Not quite a credit. We're at a very small debit in this scenario. I was hoping that would be a small credit. Let me send this to the what if calculator. So I don't mind that trade. And let's adjust it now that the market's moved on me a little bit. Let's adjust it, and we're going to go up. Let's try, this is the 15 delta right here. Let's try that one. Okay, so here's the 15 delta. That's a 1 standard deviation move. Let's buy this one and sell this one. Skip the 40 and go to the 50 and buy that one. Still got that debit of near close. All right, so we're going to have to go 7 points wide. Okay, so let's clear this out. We need to get this done for a small credit to the account. So we're going to buy this one. We're going to go to 327.50. We're going to sell that twice. And then we got to go up 15 points from there. So if we take 327.50 plus 15, that would mean we're going to skip the strike. We got the 342.50s. We're going to buy that one. And we can get it done for a credit of 41 cents. All right, that's not bad. So this is going to be the paper trade on the upside. And I'll send this one to the what if calculator. 45 cents is a good number. I like that number. And I'll take screenshots of both of these. But now in this instance, now we're bringing in a 45-cent net credit to the account. The market, if the market goes down, the market's at 279.60. If the market goes down, we make 45 cents. We're going to have an additional requirement of $750. The downside here is that I wanted to go 10 points wide. So this difference, this sweet spot, is only $7.50 wide, as opposed to it being 10, giving you a better scenario as far as the option contract that you bought and versus the one that you sold and the theta decay, right? I need theta decay on the 330 strike or the 327.50 strike. I need theta decay on that in order to make this trade profitable if I am correct on my forecast. So I'd like it to be wider. I would like to be able to go 10 points, but I can't. So 45 cents is where we're at. I don't need to beat a dead horse here. it does reduce our overall risk because we didn't go 10 points. Our actual risk is from this point where we cross the zero line all the way down to there, which is $7.50. And like I've said, whenever I've set up a butterfly like this, I'm think of it as I'm selling a short spread to pay for my standard butterfly. I'm selling a short spread to pay for my standard butterfly. So 45 cents, if I can fill it there, it's all over the place. Now it's 35 cents, but if I would put it in at 45 cents, I would leave it. And if I can fill somewhere close to that, I feel pretty good about this trade. If you are more bearish, the more bearish trade, the more higher reward, if you're correct on your forecast trade, is the modified butterfly. This is the skip strike butterfly. And if I'm doing this trade, I want the market to either stay below and go down so that I can make that net credit. Or if we get the one standard deviation move to the upside, which is a lower probability trade, right? Then we'd like to land somewhere close to here on expiration. And we really hope we don't get the 2 standard deviation move. At least we don't want the gap open all the way up to 342. And I feel pretty comfortable in FedEx at this point in time that it won't gap open, but it's an earnings report. There's no way to think about it. So this trade's an odd trade in that you're just trying to make a little. And every once in a while, if you do a few of these, if you get the right setup and you do them, eventually you're going to hit a home run somewhere. It's going to land right in here, but you're not expecting it. 1 out of 10 is going to land within this teepee of your butterfly. And it's really nice if it reports on a Thursday and they got 1 day for the option contract to live, because what you want to happen is we're going to go to the 20th here. And that'll be 11 o'clock on the 20th, is eventually this green line will start morphing into this. So this would be Friday. Now, keeping volatility the same, it would actually be higher because implied volatility will come in after the earnings. At 11 o'clock on Friday, now your profit and loss graph kind of looks like this. And then eventually it's going to morph into that. So any other questions on that? All right. And our SPX trade is looking good. I think we're just going to let that ride at this point in time. We'll get a little bit of volatility in that trade, so I'm going to let that ride. If you have any questions on that, you can put them in the comment box. And if not, we'll see you this Friday. We're going to look at FedEx. We're going to have something to look at, that's for sure. The market's going to do something after earnings. And then we'll finish off our SPX trade for the week. So thanks for stopping in, and we'll see you this coming up Friday at 11 a.m. Eastern time for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.